Is your cash just sitting idle, barely keeping pace with inflation? What if you could lend your money and get a steady stream of income in return, often with less risk than the stock market? Today we're unlocking the world of bonds, a powerful tool for investors seeking stability and regular income. By the end of this video, you'll understand how bonds work, their different risk levels, how to assess them, and whether they fit into your investment strategy. We'll cover what bonds are and who offers them, what the difference is in risk between government bonds and corporate bonds, how the risk of bonds is determined, how you get paid investing in bonds, pros and cons of investing in bonds, and at the end of the video, I'll be sharing if this is a good investing option for beginners. So let's get started. Not all bonds are created equal, especially when it comes to risk. The biggest factor often boils down to who is doing the borrowing. You might hear about safe bonds, but then also about junk bonds. Why such a huge difference? It all comes back to the financial strength and stability of the borrower. Would you feel safer lending to a global superpower or a brand new unproven startup? The same logic applies here, but understanding the nuances is key to protecting your capital. The primary difference in risk lies with the issuer. There are two general types of bonds. The first one is government bonds. Issued by national governments, these are generally considered among the safest investments. Why? Because governments have the power to tax their citizens and even print money, making their ability to repay debt very high. The risk of a developed nation defaulting on its bonds is extremely low, which is why they typically offer a lower interest rate. The second one is corporate bonds. Issued by companies, these carry more risk than government bonds. A company's ability to repay depends on its business success, profitability, and overall financial health. If a company faces financial difficulties or goes bankrupt, there is a higher chance they might default on their bond payments. Because of this increased risk, corporate bonds usually offer higher interest rates to compensate investors for taking on that extra uncertainty. Given these differences, how do you as an investor figure out how risky a particular bond is? Thankfully, you don't have to be a financial detective. Independent experts do that for you. With thousands of bonds out there, how can an everyday investor quickly grasp the risk involved without spending hours analyzing financial statements? This is where professional rating agencies come in, providing a quick, easy-to-understand shorthand that can make or break a bond's attractiveness. But what do those letter grades actually mean? The risk of a bond, specifically its credit risk, so the likelihood of the issuer defaulting, is assessed by independent credit rating agencies. The three largest and most recognized are Standard & Poor's, Moody's, and Fitch. They assign letter grades to bonds and their issuers based on a thorough analysis of their financial health, debt levels, economic outlook, and ability to repay. There are different letters for investment-grade bonds and non-investment-grade bonds. Investment-grade bonds are considered lower risk and have ratings like AAA, AA, or BB with Standard & Poor and Fitch, or AAA, AA, or BAA with Moody's. Non-investment grade or so-called junk bonds have lower ratings, typically BB or lower with Standard & Fitch, or BA or lower with Moody's. They are considered riskier because the issuer's financial situation is less stable and the chance of default is higher. To attract investors, these junk bonds must offer significantly higher interest rates, compensating you for the elevated risk. So you've selected a bond. Now, how does this investment actually put money in your pocket? Unlike stocks, where you might only see returns when you sell shares for a profit, bonds offer a more consistent income stream. But is it just one payment at the end or something more regular? Understanding the mechanics of these payments is essential for planning your cash flow. There are two primary ways you get paid by investing in bonds. The first one is interest payments. Most bonds pay you fixed interest or coupon payments at regular intervals, typically semi-annually or annually. For example, if you buy a bond with a $1,000 face value and a 5% coupon rate, you receive $50 in interest each year, usually split into two $25 payments. This provides a predictable stream of income. The second is principal repayment at maturity. When the bond reaches its maturity date, the issuer pays back your original investment, sometimes called face value or principal, in full. So if you bought the $1,000 bonds, you get your $1,000 back, provided the issuer doesn't default. Additionally, if you sell your bonds on the secondary market before it matures, you might also realize a capital gain or loss. If prevailing interest rates have fallen since you bought the bonds, your bond with its higher fixed rate becomes more attractive, and you might sell it for more than you paid. Conversely, if rates have risen, your bonds might be worth less than you paid. Bonds offer unique advantages, but they also come with their own set of considerations. Let's weigh the good against the not so good. On one hand, the appeal of steady income and relative safety is clear, especially for those nearing retirement or looking to preserve capital. But what about inflation eroding your returns or being locked into a low rate when interest rates everywhere else are rising? It's vital to see the full picture before committing your hard-earned money. Here's a balanced view of the pros and cons of investing in bonds. The pros: there's income generation. Bonds provide a regular, predictable stream of income through coupon payments, which can be great for retirees or those needing consistent cash flow. Second, there is capital preservation. For high-quality bonds, the risk of losing your initial investment is low, as the issuer is obligated to return your principal at maturity. Third, diversification. Bonds often move differently than stocks, meaning they can help stabilize your overall investment portfolio during stock market downturns, reducing overall risk. Fourth, lower volatility. Compared to stocks, bond prices tend to fluctuate less, offering a smoother ride for your investment. And fifth, priority in bankruptcy. In the event of a company's bankruptcy, bondholders are paid back before stockholders. On the con side, first, lower returns. Historically, bonds offer lower returns compared to stocks over the long term. This means less potential for aggressive growth of your wealth. Second, interest rate risk. If interest rates rise after you buy a bond, newly issued bonds will offer higher interest. This makes your existing bond with its lower fixed rate less attractive, and its market value can fall if you need to sell it before maturity. Third, inflation risk. If inflation rises faster than your bond's interest rate, the purchasing power of your fixed payments and principal repayment can be eroded over time. Fourth, liquidity risk. While many government and high-grade corporate bonds are very liquid, so easy to sell, some less common or lower-rated bonds can be harder to sell quickly without impacting their price. And fifth, default risk. While low for top-tier government bonds, there's always a risk that the issuer might not be able to make their interest payments or repay the principal, especially with lower-rated corporate bonds. So, is investing in bonds a good move for you? Bonds can be an invaluable part of a well-rounded portfolio, offering stability, income, and diversification. They're particularly appealing if you prioritize preserving your capital, need predictable income, or want to reduce the overall risk in your investments. However, if aggressive growth is your primary goal, or if you can't tolerate the idea of your bond's value fluctuating with interest rate changes, you might need to combine bonds with other assets or consider different strategies. Remember that the best investment strategy is one that aligns with your personal financial goals and risk tolerance. Always do your research, consider the issuer's credit rating, and understand the terms of any bond before investing. So, are bonds a good investing option for beginners? Well, high-grade government or corporate bonds can be a good option for beginners, while junk bonds are not. Also, instead of investing in a single bond, you can further diversify your risk investing into a fund of bonds. More on this in future videos. If this video helped you understand bonds better, please hit the like button, subscribe for more financial insights, and share your questions in the comments below. Thanks for watching, and check out the next video to learn more.